we're going to talk about DeFi and money markets. Now, basically, what's important for me to showcase a bit is what basically Aave is for DeFi users and in the ecosystem, based on kind of like a user experience and what different kind of users think about us. So I made it this kind of like a quick questionnaire on Telegram, basically why people use Aave. And one of the things mainly is that people want to earn interest on their stable coins. And basically, some of the reasons are that in DeFi, you basically can get benefits that are better than in your traditional finance. So you see that the traditional finance is kind of like working against you in terms of, for example, this comment on where a bank charges negative rates, which is happening, for example, in Switzerland. And of course, in general, like one of the things why people use DeFi or Aave or any other protocol is that you basically have 24 access into the industry-leading yield. And besides that, you basically have instant available liquidity. And of course, like one of the coolest thing is that as a kind of like a composability implementator, for example, if you're building something on top of Aave or in the DeFi ecosystem, that's basically a building block for you. And then, of course, like we do a lot of memes in general. But the idea of this slide basically is to tell like how diverse the whole DeFi ecosystem is today, and how kind of like the different kinds of protocol, whether it's lending or automated market making protocols, how they actually facilitate liquidity into this space. And all this kind of like different building blocks are actually providing more value to the ecosystem by consuming each other. And one of the interesting stuff is that Aave was launched a few months ago, exactly January, 5 months ago. And this kind of like, we all know that liquidity is a network effect in DeFi. And most of the liquidity that we have in the lending pools that we have, each lending pool is basically a money market. And currently we have one money market, is based on the kind of like building blocks that are currently in DeFi. For example, there's some of the building blocks are basically liquidity swapping, for example, 1inch or Paraswap, or for example, build something on top of our protocol, such as fixed rate advanced interest forwarding, such as, for example, Blazor, 88 miles per hour, and so forth. So there's like a lot of projects here I could chill enormously. But the point of this slide is just to show like that like each and every protocol that we have in DeFi is basically kind of like a cement, and it provides more structure into the thing that we're actually building for the future. Now, like this is like a cool thing that actually we think as the whole like Aave ecosystem as a kind of like a family, and every integration brings liquidity, more people into the family, and more kind of expansion to the whole DeFi ecosystem on Ethereum. Now, one of the stuff that we had also in the protocol launch was flash loans, and it was like a feature that wasn't that much kind of built upon in the first place, because it's a developer feature. So in terms of like flash loans, you have liquidity available that you can actually consume without having that basically. So one of the interesting stuff that happened recently was the Black Thursday, where actually the flash loan liquidity went quite up. And that's mostly of DeFi Saver implementing a feature where you can close your CDP without actually returning your loan. So you basically take a flash loan, close your CDP, and sell that collateral and return the flash borrowing and keep the rest of the funds yourself. And you can have, for example, similar ways to actually create leverage margin positions. We're using flash loans, or basically collateral swaps, swapping your MakerDAO collateral. And then there's even like a no-code flash loan functionality by Furocombo, where basically you don't need development skills to execute a flash loan. And of course, there is a collateral where you can actually take vast amount of flash loan liquidity. So like the interesting part here is that what we're doing with the flash loans is that we're reusing the value that's locked into smart contracts. So pretty much when we look at DeFi in general, we usually tend to look at try to measure like how much value is locked into the smart contracts. But what's important to understand is that we also need to understand how to reutilize that particular value. And DeFi Saver implementation and the Black Thursday is a very good example. I think only on that day, DeFi Saver saved roughly 2 million worth of CDPs during that particular day. And here's pretty much an example. When I popped off, then you go gave me just a little bit. Yeah. So the point, kind of what I'm trying to say, is that like each and every protocol that's on the DeFi ecosystem doesn't basically live in a vacuum. It's more about like the composability, because like the flash loan feature itself was kind of like a tool in the toolbox of developers to build different kinds of interesting things. And I was brainstorming with Marianne Conti from MakerDAO about kind of using flash loans to swap BAT collateral to ETH collateral in their wallets, and asked that someone could build this thing. And basically on Twitter, there was a guy named David Trong, who actually in 4 days built the whole collateral swap thing. And then Fiona, which is basically just a DeFi user, came and actually used that particular tool. So it kind of like showcases the composability on Ethereum, that it's not just basically technical composability, but also there's like a lot of human composability involved. And here you see kind of like a situation where you have a developer tool, and there's basically a product build, and also there's end user actually using that product in the whole composability process, which is for me pretty cool example. Yeah, here's an example how the collateral swap works. She says she wanna dance, but she don't know how to. I'm iced out, ooh, looking like a star. Ooh. Her name is Jenny, ooh, bitch don't have no panties. Ooh. I'm Steph Curry. Yeah, so basically it's just a tool that you can actually flip your collateral in MakerDAO without returning your loan. It's a simple application, but very useful. And there's tons of things that basically people are building now on top of the kind of like DeFi foundations now. In general, like what I wanted to talk about here, besides like the background information and what's going on our side, is pretty much like the money market ecosystem. So if you think about it, like in general, money markets is kind of like a liquidity pools. It's like a big ocean, and I think DeFi itself is very good representation of this ocean, because anyone who plugs into the system, so basically when you have DAI or ETH and whatnot, you can basically participate in this particular pool. So if you kind of look at the DeFi pulse, you will see this particular picture of the ocean. And what's interesting in this kind of like ocean picture or the seas is that there's different kinds of currencies. And I see like similarities here in terms of when we look into the DeFi space, that liquidity moves from one place to another. And then similarly, we have the same thing happening in oceans, kind of like as a representation. And what's interesting here is that even though like the whole ecosystem is connected, so you can access from one protocol to another one, each and every protocol has their kind of like own peculiarities and own parameters, how the liquidity is or should be structured. So basically, there might be different kinds of currencies, stable coins, risk, and those kind of like base how deep the liquidity is in specific money market. So I think how we see now DeFi is basically the previous picture, but we know that basically there's different kinds of liquidity flows and liquidity needs. And I think in the future, like there's specific kind of like markets of DeFi where you might not have the same, for example, assets as a collateral or stable coins to borrow, but you have some particular risk profiles that you can actually want to package and use in that particular money market. And good example, for example, is the if you look at some countries like Finland. So we see in this particular picture that there's the Baltic Sea, which is actually the connector into the basins and the oceans globally. But as a sea, it's pretty much different than you expect to have, for example, in close to Japan, the Sea of Japan, or in the Pacific. But also, what's more important to understand, like besides those particularities, differences in the basins and the seas, is that you actually have a lot of lakes. For example, in Finland, it's called that we have a land of thousands of lakes, and it's pretty much true. And I see kind of like the money markets of future in DeFi acting a bit of a similar style. We will have like very big liquidity pools. We'll have like the interconnector DeFi liquidity where anyone can access. There will be different kinds of basins there. For example, there might be Aave money market and alternative money markets out there. And what's interesting in this kind of like a lake view is that those might be also kind of like closed pools for different kinds of reasons. So there might be, for example, that the counterparties want to know each other, or they want to keep the liquidity pool, lending pool in the existence of few counterparties that basically they trust, or they don't want that liquidity or that action to be seen by everyone. It could be even like a ZK pool in the future. And also there might be different reasons regarding to, for example, regulation and so forth. So like what I see in the current space is that we are now forming like the ocean of the money markets, which is the kind of like very foundations of the DeFi ecosystem. And now in the future, we're starting to get more and more like concentrations of liquidity in this ocean, and also like different kinds of lakes of money market protocols. And one of the things like what we are now working on Aave and actually releasing is basically a kind of first secondary money market pool. And in this particular pool, we are using Uniswap as a collateral. So what it actually allows us to do is that liquidity providers in Uniswap can actually use their Uni tokens and park them into the new Uniswap pool that we have in Aave to basically leverage out to borrow, for example, stable coins and leverage their current Uniswap liquidity provider functionalities there. And at some point, you can also borrow those Uni tokens, for example, if you want to hedge your different kinds of positions. And as an experiment, this is pretty fascinating because it's kind of like a first time ever we're doing anything like this. And it really provides interesting functionality for the whole DeFi ecosystem. And we get this kind of like a derivatives of market capitalizations around the Ethereum DeFi ecosystem. And like it's kind of like pretty simple. If you are interested in trying out and seeing how the system works and using kind of like Uni as a collateral, we currently support Ropsten. So we launched it a few hours ago publicly. So basically uniswap.aave.com, and you can basically try it out. And once we are more confident with the launch and our audits on the smart contract is finished, basically we are releasing this thing on mainnet, and that's very fascinating. And you still have the kind of the main pool that we have in the protocol, but also there is now this secondary pool. And the idea is to basically add those different kinds of basins of seas, and besides of that, also add those kind of lakes where you basically need the liquidity to be disconnected. And the key difference here is between that ocean example and the DeFi ecosystem is that you can actually connect those lakes with the ocean whenever basically those pools are ready for that. And the main thing is, of course, like we always talk a lot of risk recently because of the different kinds of events that has happened in the DeFi ecosystem. And one of the most important things is that we have some sort of like a governance how we create new pools, or how new pools are added into the protocol, and basically how we manage the risk there. So everything boils down to the kind of like a macro and micro governance. So we have the Aave protocol where when there's a new pool that could be added into the protocol. So everyone can create a pool, but eventually to get into the protocol-based insurance, where we're using a staking mechanism where value is staked as a first line of insurance, and there's the second line of insurance where basically there is minting of a collateral in case of worst case scenarios with a built-in backstop system. So the idea here is that basically when we are increasing the depth cap in the protocol by adding this new basins of seas or lakes into the protocol to support them, we need to ensure that there is enough capitalization to ensure if something goes wrong. For example, if the collaterals lose their market value in certain amount of time. Now, basically, that's the kind of like a way how we govern the money markets and provide more security there with the insurance functionalities. And also, like, the idea is to incentivize that behavior within our protocol. But besides that, I think one of the issues in the governance today that we have seen recently is that the power is on the holders of certain kinds of monetary policies, which is, for example, the token, and less value is actually in the people who are actually using and consuming that liquidity. So besides the kind of like a macro policy that I explained a moment ago, we also have micro policies. For example, that will be lending pool specific changing of parameters to adjust liquidity, and those things are governed with a token. So all of the depositors are able to participate in that kind of like a macro governance, and it really might seem like a valuable proposition for the whole like current governance systems that I have seen recently. And yeah, pretty much the idea is to have a positive feedback loop. When we create more depth, we should be responsible enough to incentivize basically the insurability of those money markets. And it's interesting to see like how this dynamics will work, because if we have overly amount of debt that we can't insure, the debt just becomes pricier. So it's a way to actually reduce cost of the debt markets that we have. And yeah, so this is basically the team working behind Aave, and we're very proud of what we have achieved so far. We also go by the name of Avengers, and if you want to ask anything after the talk, for example, you can join our community in Telegram or in Discord, aave.com/Discord. And pretty much that was it for today.